All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our weekly options recap. I wanted to jump on here today, as we like to do on Fridays, take a look at some of our recent trades that we've closed out. We closed out of a couple of winning trades on our overnight pop trade service. So we'll talk about that here in just a few moments. I'll also take a look at a couple of new trades that are on our radar for next week. Setups on AAPL and IYR. IYR is the real estate ETF. So walk you through some trades that are of interest to us going into next week. Walk you through the chart pattern behind the trades, and then also walk you through how we're structuring the trade on the options side as well. If you have any questions during the session today, feel free to post those here into the chat. If you're watching the recording, feel free to contact me directly, mike@netpicks.com. More than willing to help out with any questions you might have. So let's start out by talking about market big picture. Let's recap the week here. It's been a pretty interesting week again this week. This is a daily chart of SPY. You can see that we did hit a new all-time high here on a Wednesday up at 398.12. We've talked about how that 400 number on the upside is lingering out there. Everybody's expecting that level to be tested before we see a big significant pullback. And that makes sense. With another $2 trillion being thrown at the system with pandemic relief, you would have to expect this bull market to continue. What would throw a wrench into things? We have seen some interesting price action in the bond market this week with yields on the rise. So that could potentially, if we start to see rates, continue to spike, that could potentially throw a curveball to a market that is 100% bullish at this point. Everybody is long, just expecting, hey, if there's any weakness, the Fed will come to the rescue and save the day, right? I mean, how many times have we seen it? So everybody's expecting that move up to 400 if we do end up getting up to that level here over the next week or two. I would expect there to be very strong resistance at that level. I don't expect us just to break right up through that level. I do think that will be an area that we could potentially see a tradable pullback. Now, what if we don't get up to that level? What if we do start to see some selling already going into next week? Some areas of interest. We broke through the 8-period EMA yesterday. The 8-period EMA is the solid pink line there on my chart. We broke through that level on a closing basis yesterday. And here today, notice we are testing the two green lines right here. Those are the 20-period simple and exponential moving averages. Those levels are widely tracked by most traders, both day traders and swing traders. No surprise that we are seeing a defense at those levels. The bulls are stepping in there. We are finding support, at least initially. Here we are going into the afternoon. We're off the lows, trying to head back up above those levels. If we head back above those levels into the close, if we can close above the 8 EMA as well this afternoon, let's just say we see an afternoon rally, we close near the highs of the day, that could set us up for that move up to 400 next week. So on the downside, if we do break those 20-period moving averages, both the simple and the exponential, we've got the 50-period moving averages. Those are the yellow lines down towards let me get my data box up. We'll get the exact values for you. So those levels are currently sitting at 385.39 and 384.03. That's going to be an area of support should we get down to that point next week. Again, that would happen most likely due to a move in bonds going into next week. So that's something we'll watch closely. The volume. Yesterday's volume was very good, which makes sense. We had some selling yesterday. Volume on the selling has certainly been higher. We got up above 100 million shares yesterday on that selling. We've talked about this theme the last few weeks, the rally back up towards those highs. Anytime that we get up towards those all-time highs, the volume drops off a cliff. The volumes tends to struggle to get up towards that 80 to 100 million share range. So I don't know if that's going to be enough volume to get us to plow right up through 400. If we're going to get an extended move higher from these already lofty levels, we would need to see some volume kick in my opinion. So going into next week, we have a market that I think a lot is going to depend on what happens this afternoon. If we get a close up near the highs of the session, I would go into next week leaning towards the bullish side, expecting a push back up to the all-time highs. If we start to get some afternoon selling, I do think it sets us up for a move down towards the 50-period moving averages early to midweek next week. The VIX, what's interesting here, the VIX is look at the volatility market-wide, specifically the S&P 500. And the VIX, for most of the last 12 months, has been very firm above the 20 level. It's been a historic move. We haven't seen moves like this in the past where we stay this elevated for this long. Normally, when you see that VIX above 20, it'll last for a couple days, maybe a couple weeks at a time, but certainly not 12 months. Well, here this week, we did briefly break the 20 level back when we hit that all-time high on Wednesday. We are starting to move lower again today. We're sitting at 20.20. If we break the 20 level again this afternoon, I would look for further weakness in the VIX next week. We haven't seen a move down below 20 for any length of time. Anytime that we test that level, the VIX bounces higher. We start to see equities roll over and volatility expand. So we'll want to watch that 20 level closely this afternoon and also early next week to see if we continue to get volatility to contract. The ATR, which is the indicator down at the bottom of my chart here, that is the average true range. We've talked about that here over the past number of weeks, really. It was great to see that ATR go from around 4, just over 4, to around 6.5. It was great to see that range expand. Notice here this week that we have seen that ATR start to contract, meaning we don't have as much movement to work with intraday. Not a deal breaker. It's just something that we want to watch closely. I want to see that ATR stay above 4. If it stays above 4, it gives us enough movement to work with. When it starts to go down below 4, it just indicates a much slower market environment. And as active traders, we want that activity. So definitely want to watch ATR closely into next week as well. So let's talk about our overnight pop trades that we put on yesterday afternoon. I like to talk about these trades because coming into the Friday sessions, we're always closing out of these trades, Friday morning trades that we put on Thursday afternoon. So I'd like to recap what happened on the trades that we took. And let's start out with IWM. This is the Russell 2000 ETF. For those of you that are not familiar with the overnight pop trade, it's a setup that we like to use credit spreads on going into options expiration. Any stock or ETF that has weekly options will have options that expire on Friday. So we can look for this type of trade Thursday afternoon for Friday. SPY, which is the S&P 500 ETF, we can look for trades 3 times a week. Friday afternoon for Monday expiration, Tuesday afternoon for Wednesday expiration, and then Thursday afternoon for Friday expiration. So SPY is a great product. I'll talk about that one in just a moment. But IWM, we looked at this trade yesterday afternoon. We like to put them on right around 3:30 Eastern time, 30 minutes before the market closes, the day before expiration. So what we did is we came in and we sold a call spread. Selling an out of the money call spread like we did, it's a neutral to bearish position. Ideally, we want the stock to move lower. We just don't need a big move lower. And I had some questions on this. People writing in, some of our customers writing in yesterday afternoon asking, like, why would we sell a call spread leaning bearish when the market was already overdone yesterday afternoon? Some of those people were expecting the market to bounce higher. My response was, with this type of a setup, I'm not concerned with what happens all day on Friday. I'm concerned with what happens Friday morning right at the open. Because in many cases, we're going to be able to close out of these trades during the first 20, 30 minutes of the session. And what I was looking for, because the market closed so weak yesterday, I was looking for one more push lower. I was looking for one more move to the downside before the market rallied higher. And so my response was, we know Fridays have been very strong all year. Not concerned with what happens Friday afternoon. I was looking for what was going to happen Friday morning. And with that market closing so weak yesterday, I was expecting one more push to the downside this morning. That's exactly what happened. Didn't last very long. The markets certainly rallied back higher. You can see it on the screen. There's a lot of green on the screen at this point. So what we did, the trade that we put on yesterday is we came in and we were using the March 19 options that expire at the end of the day today. And we sold the 229, 231 call spread. I sold the 229 call and I bought the 231 call at the same time. We put this trade on originally yesterday for 54 cents. $54 per spread is what we collected to put the trade on. It tied up $146 of capital per spread. That was the most I could have lost on the trade. So less than $200 per spread. It can definitely be taken with multiple contracts, multiple spreads, very liquid product. Some of our members had difficulty getting filled on this trade yesterday because the market was so active yesterday afternoon. During that last 30 minutes, the market was all over the map. So it was a mixed bag. I would say it's probably a 50-50 split, with 50% of our members being able to catch the trade. Some people were not able to. So the reason I bring that up If you miss these trades, if you can't get filled at a good price, in this case, we said 45 cents or higher was what we were looking to get filled at yesterday. If you can't get filled at a good price, we would rather walk away from the trade. I would rather get filled at a good price or not at all. Because if you start to chase the trade, if it starts to move below 45 cents, the problem there is all of a sudden your risk reward does not become as attractive. I want to pay attention to that risk reward. I'm okay risking between 2 and 3 to make one. I am not okay risking 4, 5, or 6 to make one. The numbers just don't work long term. So we ended up closing out of the position first thing this morning. We got filled at 14 cents. We bought the spread back for 14 cents, gave us a $40 profit per spread, 27% return on our capital overnight. Again, we opened the trade just after 3:30 Eastern time, right at 3:30 yesterday afternoon. And then we closed out of this trade during the first 5 minutes of the session, right after the opening bell. That's why I love these trades. It's not always going to be that easy. It's not always going to be able to, close out first thing Friday morning. There may be sessions where we have to hold into midday or maybe even early afternoon. But more often than not, we're going to be able to take action on these right at the open. And it's just a nice way to book some profit, not have to sit there all day long, book those partial profits here a couple times a week. It just generates another reliable source of income. Let me show you the details of this trade here. And it's this one right here down at the bottom. It was the IWM trade. You can see the profit there, $40 per spread, $120 of profit if you used $500 of risk per trade, which is what we typically track with our spreadsheet here. And that's 19 winning trades in a row. It's not always going to be this easy, right? We're not always just going to have winning trade after winning trade. If we go back, back to early February, we did have a couple of losers. They're going to happen. What we're looking for is a very high winning percentage. Fortunately, we have that. And the reason we have a high winning percentage is because the credit spreads allow us to see 5 ways of making money on the position. They're much more forgiving trades. I don't need a big directional move to make money on these overnight trades. Okay, so that was a really great position there on IWM. We took one other overnight trade, and this was with our ETF Option Superstars program. And this one was utilizing SPY. This is the S&P 500 ETF. We sold a call spread, so very similar to IWM. We just used a different product. We just used the S&P 500 ETF instead. We came in and we sold the 394, 396 call spread, meaning I'm selling the 394 call, buying the 396 call at the same time. We collected 48 cents or $48 per spread. It tied up right around $150 of capital per spread. We closed it out first thing this morning. Within the first 5 minutes of the session, we bought it back for 14 cents, gave us a $34 profit per spread, 22% return on our capital, in and out overnight. Okay, so in fairness, we did have, if we go back to last week, we did have a losing trade on the Dow ETF with our overnight pop trade. So it's certainly going to happen. Thursday afternoon into Friday last week, we ended up taking a 31% loss on the losing trade. So we're going to have winners, losers, break evens along the way. Fortunately for us, because we have those 5 ways of making money on the trade, we're going to have a very high winning percentage. On this SPY trade, we made money. If the stock moved up, down, or sideways, didn't matter as long as price stayed below 394. Well, we saw a low this morning. I'm trying to see on my other screen here. The low of the session was at 387.15. Well below, am I looking at the wrong? Yeah, 387.15 was, I'm looking at the wrong number. Where's it? Sorry, guys. I'm trying to look at one of my other monitors on my other desk. So I'm trying to see. Yeah, 387.15 was the low. So we needed a price below 394. It did end up opening lower this morning, so we were able to book the nice profit. And we move on. We free up the capital for the next trade. We will be looking for another overnight pot trade this afternoon, going into Monday's expiration. And we'll be looking for that trade on SPY. So we'll typically send those trades out to our customers, to our members, around 3:30 Eastern time during that last 30 minutes of the session. All right, let's take a look at a couple of new trades that are on the radar for next week. And we're going to start out with IYR. This is the real estate ETF. I talked about the bond market being active, and that's really what caused some of the uncertainty the last few days. With interest rates on the move, interest rates rising. When you take a look at the real estate market, mortgage rates are tied to the 10-year note. So as we start to see interest rates rise, obviously, it's a headwind for the real estate market, which has been on fire here. I mean, really since the pandemic kicked in, when they started to announce all the stimulus, the housing market has been phenomenal. Well, we're starting to see price action roll over a bit. We got overbought here because our pulse indicator got yellow. Our pulse indicator down here, it indicates when prices hit extremes, and what that yellow bars, or the series of yellow bars meant, price was between a 1 and a 2 standard deviation move. Doesn't mean price can't move higher from here. It just means it's not probable. Only 13.6% of all occurrences will fall outside of this range on the upside. When you start to see those yellow bars, it'll typically lead to a period of consolidation or even a reversal in the other direction. When I see that type of reading, in a lot of cases, I'm looking to sell an out of the money call spread. And if you did that here, I'd have no issue with that. But because we have seen price start to break the AEMA here, that's that red and blue line up top, I'm actually interested in looking at a long put. So let's come over to the trade page. And for this setup, I'm going to use the April monthly options. The April options have 28 days left to expiration. I'm typically looking for options that have between 20 and 60 days left. In a lot of cases, 20 to 40 days is where we're at. And April has 28 days left to expiration. So we're going to open those up. And I'm going to come to the put options on the right-hand side. Normally, I like to go slightly in the money. Okay, so if I were to go in the money on these options, take a look at the 92 or the 93 put, the issue there's just not a lot of activity in those options. Okay, if we take a look at the volume and open interest numbers, not a lot of interest in those in the money options. So this is one of those cases where I would actually be okay going slightly out of the money. It's not ideal. Ideally, I want to be in the money. But without that liquidity, I would be taking a look at the 90 puts, for example. The 90 puts have 2,000 contracts of open interest and 800 have traded today. More activity there. It's just going to be easier to get a fill. And if we were to buy the 90 puts here, we're talking about between $130 and $140 per contract. Very reasonable. It is an aggressive bearish play. When you buy a long put, you've got one way of making money. We need that stock to move to the downside. If we just chop sideways or maybe we reverse back to the upside, we're going to lose money on the position. So it is an aggressive play. I don't mind taking long calls and long puts at times, as long as it's not the only strategy in my toolbox. I do want to trade a fair number of credit spreads. Sole reason, they're more forgiving. Okay, so let's take a look at one of those for next week as well. Let's go over to Apple. And we'll wait for TradeStation to load up the chart. I am looking at the 195-minute chart. Couple things to point out. Number one, price action is oversold. And how do I quantify that? We've got the yellow bars in the pulse. The yellow bars indicate price being between a 1 and a 2 standard deviation move on the downside. Right? Only 13.6% of all occurrences fall outside of that range on the downside. In all likelihood, we're going to see a period of consolidation or even a reversal to the upside. We have started to see some chop kick in this week. We've seen Apple try to bounce a couple times. So far, those bounces have been sold. So we've got to point that out. We found resistance at both the AEMA and the 50-period EMA, which is the white and yellow line. But a couple things that I want to point out. Number one, we know Apple does not typically like to stay down for very long. A lot of those dips are bought up pretty quickly. This has actually been one of the longer stretches over the past few weeks where Apple has stayed weak. Definitely due for a bounce here in the near term. We've also got to take into account what's happening market-wide, but also what's happening in your overall portfolio. And the reason I bring that up, if I take a look at my portfolio, I've been very active taking positions off over the past week and a half. And if I take a look, I still have a lot of short call spreads on. I've got a lot of bearish positions on. Definitely leaning more bearish, which I don't always like when I lean too heavily in one direction or the other. I want some balance there. So I'm actually going to take a look at selling an out of the money put spread for a few reasons. Number one, the chart pattern here is oversold. We just talked about that. But also I want to get some bullish exposure on, because if we do start to get a bounce here, I want to have some trades on that would benefit from that. We know the NASDAQ has been weak. The NASDAQ has been lagging behind the last few weeks. The Dow has done its job on the upside, right? The Dow, the S&P, the Russell, they have stayed very strong, but the NASDAQ's been weak. And we know over the past 12 months, we continue to see a lot of sector rotation, right? When the Dow is strong, the NASDAQ's weak. When the NASDAQ takes the leadership role, the Dow starts to sell off. I could certainly see that happening again going into next week, where we start to see the NASDAQ come to life a little bit, start to see some of these tech stocks move to the upside. So what I'm going to do is go over to the trade page and let's take a look. Switch the symbol from IYR to Apple. We are going to stick with the April monthly options with 28 days left to expiration. I'm going to take a look at selling an out of the money put spread. I'm going to come to, let's take a look at the strike prices that are available to us. Let's go ahead and take a look at the 116.25 put option. I'm going to right click on that option. The reason I went to that option, it's got right around a 64% chance of closing out of the money. You can see that probability out of the money column on my trade page here. I'm going to right click on that option. I'm going to go to sell and I'm going to select vertical. It is going to pop up an order down at the bottom where I am selling the 116.25 put. And by default, it has me buying the 115 put. I am going to stretch. I'm going to stretch that 115 put out a bit. I'm going to move it to 113.75. So in this case, I'd be selling the 116.25 put and buying the 113.75 put. Let's take a look at the risk reward. I'd be risking $178 on this trade to make 72. So we're between risk 2 and 3 to make 1. That's a very acceptable range. That's very typical for us. I'm okay with that because we've got 5 ways of making money on the position. In this case, I would make money if Apple moved up, down, or sideways. Doesn't matter to me as long as it stays above the 116.25 short strike. So up, down, or sideways, it doesn't matter to me. But if Apple moves higher, I'm going to make money faster. If we chop sideways or if we drift to the downside here at these levels, I could still make money. I'm just going to have to hold longer and wait for that time decay to add up in my favor. All right. That time decay will add up every day that passes, regardless of what price does. Time decay is working in our favor. So if we aren't right away, if we see this stock continue to move lower for a few days, the time decay is going to add up, and that allows us to recover much faster. Should we bounce higher next week, that bounce higher would allow us to recover much faster. That's why I love the credit spreads. And then we also make money from volatility decreasing. We talked about the VIX contracting here this week. If that continues heading into next week, that volatility contraction would be the 5th way that I can make money on the spread. So it is a neutral to bullish trade. If we do get filled at 72 cents, that is the max profit on the trade. The only way that I'm able to book that max profit is if I hold all the way up to expiration. Not something I'm looking to do. I would like to close it out when I can keep between 50 and 75% of the max profit. So if I could buy this thing back anytime over the next 28 days, if I can buy it back for between 18 and 36 cents, that would be a desirable range. Okay, allow me to book the profit, free up the capital for the next trade, and not have to worry about holding all the way to expiration. So IYR, a bearish position on tap for next week, and then Apple is a neutral to bullish position, just trying to get some diversification here into our trading. All right, so if we circle back real quick to the daily chart, again, while I'm talking here, the market trying to bounce off of the lows, trying to head higher here. We're actually up near the highs of the session, and we'll see if that continues going into the close today. I'll be back on Wednesday next week. We'll jump back on for our midweek update. We'll see how IYR and Apple end up playing out for us, see if we can get those trades on. If you have any questions between now and then, feel free to email me directly. Mike@netpicks.com is the email address. Otherwise, I'm going to start to wrap up here for today. Enjoy your afternoon. Enjoy the weekend, everybody. If you're a sports fan, enjoy all the basketball games. I know it's a full weekend for the sports fans, so enjoy that if you're going to partake. All right, so enjoy your weekend, everybody, and I'll jump back on Wednesday for our next midweek recap. Hope to see you there.